Okay, let's dive right into this explainer. We're breaking down what is honestly one of the most critical, and let's be real, most stressful decisions for Greater Toronto Area homebuyers in 2026. We are talking about the great debate, fixed versus variable mortgages. Buying a home in the GTA is already a massive undertaking, right? But the mortgage structure you choose today is going to impact your monthly budget just as much as the actual property itself.
So we've got a lot of ground to cover to help you build a solid strategy, and here's the path we'll be taking. First, we'll look at the 2026 GTA mortgage market. Second, fixed rates. Third, variable rates. Fourth, we'll cover why the GTA is entirely unique. Fifth, the hybrid trend. And finally, finding your perfect fit.
All right, Part 1, the 2026 GTA mortgage market, where stability meets uncertainty.
To make a truly smart choice, we have to look at exactly where borrowing costs are sitting right now, especially after some of the fastest rate hikes in Canadian history. Look, we aren't just comparing minor decimals anymore like we were a few years ago. In today's elevated market, even a tiny 1% shift, it carries massive, massive weight.
Because in the GTA specifically, a 1% difference literally equals hundreds or sometimes even thousands of dollars flying out of your pocket every single month. When you're dealing with home prices that are already sky high, this one decision can completely alter your day-to-day cash flow.
So looking at the current landscape, it's kind of a mixed bag. The Bank of Canada has thankfully pumped the brakes on those aggressive hikes. And yeah, economists are expecting some gradual rate cuts over time. But make no mistake here, borrowing costs are still elevated way beyond what we saw during the pandemic. You've really got to balance your personal risk tolerance against all this lingering market unpredictability.
Which brings us to Part 2, fixed rates. Predictable and secure. It's all about locking in your payment.
A fixed-rate mortgage locks your interest rate in for a full term, usually around 3 to 5 years. And if everyday costs like climbing property taxes, utilities, and grocery bills are already pushing your budget to the absolute brink, fixed rates are incredibly popular right now. Why? Because they offer absolute consistency. They protect you from future hikes and seriously reduce financial anxiety. But there is a catch. You're paying a premium for that security. If rates drop, you miss out, and if you have to break the mortgage early, the penalties can be painfully expensive.
Okay, moving right along to Part 3, variable rates. Flexible, but unpredictable. Riding the market.
So what if rates actually do start dropping? Well, variable rate mortgages fluctuate right along with the Bank of Canada's overnight lending rate. They offer this tantalizing possibility of real savings if rates go down over the next year or two. Historically speaking, they've actually outperformed fixed rates over the long haul, and they usually have much lower penalties if you break early. But this flexibility demands an iron stomach for volatility. Your payments could spike unexpectedly, making your monthly budgeting a whole lot harder.
It really comes down to this fundamental trade-off. You're essentially deciding between paying a premium cost up front for absolute peace of mind or taking on potential emotional stress and payment shock for the chance at long-term savings and lower penalties. It's your classic risk versus reward scenario.
Let's hit Part 4, why the GTA is different. The stakes for borrowing here are just uniquely high.
The GTA market is honestly a beast of its own, because mortgage balances here are significantly larger than in most of the country. And those massive balances, they magnify the impact of even the tiniest interest rate changes. Because affordability is already stretched incredibly thin, getting the structure wrong creates immediate, intense financial pressure. It forces so many households in places like Brampton, Mississauga, or Milton to rely heavily on side income, think basement apartments, rental suites, or strict dual incomes, just to keep their heads above water.
Which naturally leads us to Part 5, the hybrid mortgage trend. Is it the best of both worlds?
Recognizing these absolutely massive stakes, a lot of experienced buyers are ditching the all-or-nothing gamble. You can actually hedge your bets here. Enter the hybrid or split mortgage. It's exactly what it sounds like. It combines both a fixed and a variable portion into one single mortgage. So you secure a chunk of your debt against sudden rate hikes for baseline stability, while keeping one foot in the variable door to capture any potential rate cuts.
And beyond split mortgages, another strategy gaining a ton of traction right now is taking a shorter-term fixed rate. Think a 2 or 3 year term instead of locking in for the traditional 5. By using these hybrid or alternative setups, you're building a customized defense. You aren't just blindly chasing the cheapest rate, and you avoid totally relying on perfectly timing the market, which, let's be honest, even the experts can't reliably do.
All right, Part 6, finding your perfect mortgage fit. Let's run through a quick self-assessment framework.
At the end of the day, this decision is all about your personal reality. If your finances are stretched to the max, or maybe you're a first-time buyer navigating all these brand new expenses, and the mere thought of a payment jump keeps you up at night, then locking into a fixed rate is exactly what you need. It's your financial safety net, pure and simple, letting you budget with total confidence.
On the flip side, take a hard look at your situation. Do you have real financial flexibility? If you've got strong cash flow, you can comfortably absorb short-term bumps in your bills, and you have the emotional resilience to watch your payments bounce around a bit, then a variable rate might absolutely be your path to long-term savings and lower penalties. But to really nail this down, you need to step back and honestly ask yourself a few tough questions. First step, could your household actually survive another unexpected spike in borrowing costs? If the honest answer is no, then a variable rate is likely way too dangerous for your current setup.
You also have to aggressively interrogate your own job stability. Are you a salaried employee in a super secure industry? Or do you run a seasonal business or work on commission? Because pairing a fluctuating variable mortgage with unpredictable income is a total recipe for disaster.
Ultimately, what do you value more? The absolute rock-solid certainty of knowing your exact expenses for the next 5 years, or the mathematical chance of paying a little bit less over time? It really is a lifestyle question just as much as it's a math equation.
And finally, ask yourself, do you actually have the emergency cash reserves on hand right now to bridge the gap if a variable rate suddenly pushes your payment up hundreds of dollars next month? If you don't have that cash buffer sitting there ready to go, the risk is completely unmanaged.
Please remember this, rate cuts are never, ever guaranteed. The experts have been wrong before, and trust me, they'll be wrong again. So evaluating your own specific financial resilience using these exact questions is a vastly superior strategy to just sitting around guessing what the Bank of Canada is going to do at their next meeting.
Ultimately, the whole fixed versus variable debate isn't just about finding the lowest number on a page anymore. The smartest move you can make in the 2026 GTA market is choosing the structure that aligns with your specific goals, protects your future, and above all, lets you actually sleep soundly at night. So, looking at your own budget right now, if the market shifted tomorrow, would your current strategy leave you tossing and turning or resting easy?